Hi, it's Brenton Garen with ETF Trends and ETF Database. Today I'm joined by Mark Carlson, Senior Investment Strategist at FlexShares. Mark, today's topic is US high yield sector, which, like other investment sectors, has recovered from the negative COVID-19 impact in the first quarter of 2020. Where does the sector stand and what should investors focus on within the high yield sector today?
Well, thanks, Brenton. The high yield sector, like others, has recovered from the depths of the COVID-19 downturn, and it's done so on the monetary and fiscal support from the Federal Reserve and from the U.S. federal government. Actions taken by the Federal Reserve in late March, including programs that included the investment in select high yield securities, provided the market with a much needed alternative source of liquidity and helped stabilize investors' concerns with the high yield sector. Now, some of the key developments within 2020 within the sector include an uptick in defaults and an increase in fallen angels. Now, those are issuers that had been downgraded to high yield status from their previous investment grade status. The economic downturn of the COVID-19 crisis has had a material impact on the entire US economy as business and government shutdowns led to record unemployment and reduction in goods and services. Many investment grade rated issuers who were already under financial stress due to either balance sheet leverage or business model challenges, competitive challenges, were pushed over the ratings edge with the reduction in revenue, earnings, and cash flows that resulted from the COVID-19 downturn. The corporate investment grade credit sector has seen roughly $150 billion in debt outstandings being downgraded to high yield ratings. aka this is the fallen angel scenario. As a result, the ratings makeup of the high yield sector has migrated to a higher average overall ratings level as more BB rated issuers have been added from the investment grade space. Today, nearly 55% of the high yield sector is rated BB. Now, this increase in BBs is not a recent phenomenon, but has been an ongoing trend for an extended period of time. As recently as 2008, the BB ratings category made up only roughly 35% of the sector compared to that recent 55% uptick. Investors need to be aware that the high yield sector continues to evolve with the financial markets and the economy, and they should seek opportunistic investment strategies to take advantage of this evolution. Regarding credit stress, there's been an uptick in defaults and debt restructurings in the first half of 2020, compared to the relatively benign default environment that we've seen over the last few years. However, many of these events have been concentrated in sectors that have come under acute duress during the recent economic downturn. Some of those sectors include energy, retail, and consumer discretionary spending areas like dining, travel, and leisure. With states and cities issuing stay-at-home orders and closures of major business sectors, consumer spending has been negatively impacted, hurting traditional retail and discretionary spending on food and entertainment away from home. The energy sector suffered a double hit as demand destruction, combined with an ongoing price and market share wars between global oil producers, resulted in plunging energy prices, driving levered energy firms over the financial ledge. Defaults are likely to continue to increase as the economic impact of COVID-19 will take time to address. However, to date, the high yield sector has taken this outlook into account, repricing these more vulnerable sectors for their increased risk. Despite these challenges in 2020, the sector overall has nearly recovered in terms of year-to-date total return from the downturn in price performance that resulted in the widening of credit spreads, known as option-adjusted spreads, or OAS. While OAS spreads on a benchmark index like the Bloomberg Barclays High Yield Index are still roughly 170 basis points wider year to date, the higher yields of the sector have rewarded investors through higher income generation, offsetting negative price actions. This is one of the strategic advantages of the high yield sector. Higher yields can provide more timely compensation for the risk of price losses as compared to other fixed income sectors.
Great, Mark. You've mentioned the importance of yield in the total return opportunities in high yield. How do you and Northern Trust FlexShares recommend investors pursue yield within the sector?
Well, Brenton, the importance of yield cannot be understated when it comes to identifying the components of total return in the high yield sector. Research by Northern Trust Asset Management shows that on average, the entire amount of long-term total return performance in high yield typically comes from the yield income component. With this insight, it benefits investors to emphasize yield in their high yield allocation. Now, when we talk about emphasizing yield, we're not advocating for a pure yield grab. Many debt securities trade at a very high yields because they represent very high risk of capital loss through default. Working with Northern Trust Asset Management Quantitative Research Group, FlexShares has developed a high yield investment strategy that uses value and quality investment factors to construct an underlying rules-based index that seeks to maximize risk-adjusted yield while remaining duration neutral and therefore not undertaking undue interest rate risk, and remain well diversified, avoiding allocation risk, two risk factors to keep similar to the overall high yield sector. This quantitative strategy seeks to identify and allocate towards risk-adjusted, undervalued issues and de-emphasize overvalued securities and issuers that our proprietary credit scoring model identifies as among the weaker financial and business profiles within their respective sectors and peer groups. The FlexShares High Yield Value Scored Bond Index Fund, ticker HYGV, uses this multi-factor model index to create an ETF that seeks to deliver improved risk-adjusted yield and total returns to investors.
And finally, how should investors position the high yield sector in their portfolios, given some of its unique investment characteristics?
Yeah, we believe that high yield should be part of every portfolio allocation, even those clients with very low risk profiles due to the income generation capabilities of the high yield sector. We look at it, we advise looking at high yield as the lowest risk sector of the class of higher risk sectors such as US equities or global equities, or say emerging market securities. This is because high yield captures a significant amount of equity risk premium, having good correlations with equity returns, but with lower overall volatility. Through high yield, you can participate in the upside of risk assets, but gain some level of downside protection. This is an attractive alternative, especially given the current uncertain environment. With its value and quality factors approach, HYGV, we feel intelligently assesses credit and market risk to construct a high yield portfolio that seeks to maximize risk-adjusted yield, to deliver high current income, and therefore improve total risk-adjusted returns for your clients' portfolios.
Thanks, Mark. Thanks for joining us today with all of these great insights.